Hi YouTube, it's Average Joe, your channel where we talk about anything around personal finance and smart money moves for the everyday guy.
Have you ever thought about investing but never really started, or just that you don't know how to get started? Basically, this video is not for an advanced trader or investor, but rather for the average Joe, or the person who wants to revisit the basics. We will explore why, what, and how to get you going and start that journey. Before we start this video, you are most likely already investing in the stock market without knowing it. Let us explain. In the United States, as an example, approximately 55% of households own stocks either directly or indirectly through retirement accounts like 401k. That's more than half of the population, realizing the importance of stock market investments for their financial futures. Let's go back to the basics to understand why people invest in the first place. If we look at the last 50 years, the stock market has trended on average 7 to 9% per year, which is based on the performance of the S&P 500. Past performance of the stock market does not guarantee future results. It does, however, give us an understanding of how the market reacts to various events. We believe that money you put into the stock market should be there for the long run, a minimum of 10 years. How much should I invest is a common question. It depends on various factors, such as your income, financial goals, and your life situation. However, the average person invests around 200 to 300 USD a month. What you will invest comes down to how comfortable you are with the stock market and betting your money on it. A rule of thumb is only to invest what you are comfortable to lose. It might sound scary, but it is the reality. And often it's better to start investing with a little bit of money, and then as your knowledge improves, you can increase that amount. When you start investing, remember that time is your friend, so be patient. Let's take an example on how time can create wealth. Your initial investment is 300 USD. Each month you invest another 100 USD to your account and continue doing so for the next 40 years. If your investment were to yield 7% per year, in the end of the 40 years, your account would be worth a whopping 244,000 USD. The amazing thing is that of those 244,000, only 48,000 USD have been invested by you. The rest is what we call compound interest rate. Albert Einstein called compound interest the eighth wonder of the world. Once we understand the why to invest and how to invest, we need to understand the what to invest. There are several various assets that you can invest in, some more complex than others. It's important to start building your knowledge around investing. Stocks and ETFs will give you the fundamental to advance further if you'd like to. A key thing in order to be successful is to use strategy. It's important to find a strategy that you are comfortable with. We'll start off by looking at the stock market. The stock market offers various assets that you can invest in. Let us cover some of those. Let's first look at stocks, which indicate ownership in a certain business and have the ability to provide returns in the form of dividends and capital gains, which means that your investments can increase as the value of the stock increases. You may also experience dividends, which is a payout from the company to the shareholders. This money can then be reinvested to increase your future gains. Pros of stock. Over the long term, stocks have the potential to produce high profits. Stocks provide you the chance to invest in particular businesses or sectors you think will do well. Stocks can provide diversification because you can invest in a variety of equities from various industries and areas. Cons of stock. Stocks can fluctuate in value quickly and can be very volatile. Compared to some other investment types, they pose a larger risk. Selecting companies to invest in can be challenging, and success takes thorough investigation and analysis. Secondly, we have ETFs, exchange-traded fund. Commonly known as an ETF is a fund that holds various stocks and often tracks a specific index or industry. The idea of an ETF is to diversify the investments and by doing so, lower the risk. This is a popular investment form amongst investors since it offers diversity, low fees, and low risk. Pros of ETF. ETFs offer a great diversification since it gives exposure to a wide range of stocks and other assets. By diversifying your portfolio, you will automatically reduce the risk you take. You can invest in several stocks without buying them individually. Investing in an ETF that tracks a specific index such as the S&P 500 can give you the ease of mind. You don't have to deep dive into individual companies when investing in an ETF. Cons of ETF. Since an ETF is designed to often track a specific index, there is less flexibility to decide the stocks within your portfolio. There tend to be fees connected to an ETF. These fees will cover the management of the ETF. You may experience tracking error with some ETFs, which is the discrepancies between the ETF's performance and the performance of the index that it is tracking. Warren Buffett is a living legend when it comes to investing in the stock market. He even started at 11 years old. His philosophy for investing is brilliant, and it comes down to time and focus. But in essence, he recommends the average investor to buy an ETF following the S&P 500 and then buy the average. It means that every month you buy into the ETF because you will never know the dip and the peak of the market. And by buying the average, you get the best possible exposure to risk and reward, and not to mention you do not have to spend time learning the market. So let us summarize what we have gone through and the key steps and considerations to help you navigate this financial landscape successfully. Educate yourself. Start by gaining a solid understanding of investment fundamentals. Learn about different asset classes such as stocks, bonds, and mutual funds. Familiarize yourself with key investment concepts like risk and return, diversification, and the power of compounding. Set clear goals. Determine your investment's objectives. Are you aiming for long-term growth, generating passive income, or funding a specific financial goal? Clarifying your goals will guide your investment strategy and decision-making process. Assess risk tolerance. Assess your comfort level with risk. Understand that higher returns often come with higher risks. Evaluate your financial situation, time horizon, and willingness to withstand market fluctuations. In essence, ask yourself, how much am I willing to lose? Diversify your portfolio. Don't put all your eggs in one basket. Studies have shown that a diversified portfolio tends to be less volatile and provides more stable returns over time. So, mixing and matching your investments can be a smart move. This way, you can potentially minimize the impact of any single investment's performance on your overall portfolio. Find a brokerage. Select a reputable brokerage or investment platform that suits your needs. Consider factors like trading fees, account minimums, research tools, and customer support. Ensure the platform offers a user-friendly interface and access to the investments you are interested in. Stay disciplined and patient. Investing is a long-term endeavor. Avoid making impulsive decisions based on short-term market fluctuations. Stay disciplined, stick to your investment plan, and be patient. Consistency and a long-term perspective can lead to better results over time. To end this video, let us understand what Warren Buffett advice is. Despite Buffett being the chairman and CEO of Berkshire Hathaway, he still recommends the average retail investor to invest in an ETF that follows the S&P 500. The reason being low risk, high historical return, no need for in-depth knowledge. Furthermore, behavioral finance studies have shown that human emotions often lead to common biases like overconfidence, loss aversion, and herding behavior. Understanding these biases can help you make more rational decisions in the market. Remember that investing involves risk, and there are no guarantees of returns. As we are on the topic of risk, let us share some insights to investments you might want to stay away from in the beginning. High-risk investments. Avoid high-risk speculative investments, especially if you're new to investing. This includes penny stocks, highly leveraged products, and speculative assets like cryptocurrencies. Day trading. Day trading involves buying and selling assets within the same trading day. It's highly speculative and requires in-depth knowledge, experience, and a significant time commitment. Following hype and rumors, avoid making investment decisions based on rumors, tips from friends, or hot trends in the media. In the end, be prepared to weather market volatility and stay committed to your long-term investment strategy. With time, patience, and monthly deposits to your investments, you can achieve your financial goals. As we spoke about before, long-term investment focus has historically been the best strategy. As always, if you have any questions or want to share your investments tricks, drop a comment below. We love hearing from our awesome community. Until next time, stay smart, stay financially savvy.